Hello, everyone, and welcome back to TradeFinder Live. My name is Zach. I'm one of the team here at Elliott Wave Options. Most of you out there are likely familiar with me by now, but for anyone that might be joining us for the first time tonight, welcome. It's great to have you with us. And for those of us that have been around, we already know the procedure here. We have to go through the housekeeping details about the session, and then we will get to the good stuff. So first and foremost, this is our live disclosure disclaimer agreement. If you attended any of our live sessions previously, then you've seen this. The main thing to take away from it is that we are not licensed investment advisors in the United States, so nothing is to be taken as personal investment advice. We do have this available on our website if you'd like to read it in full detail there, or certainly feel free to take a screenshot of it now if you like, but that's the main point to take away. All right, so again, most of us are likely familiar with the Q&A process. Rob will go through we'll go through his presentation, some case study considerations, and then with the time remaining, we'll open it up to questions. Now, please keep in mind, we are live streaming to multiple different platforms, and on top of our Zoom audience, we'll never get through every single question. There's just not enough time. So please know if we don't get to your question, it has nothing to do with the validity. It just came down to time limitations. So please take that as encouragement to attend the insiders meeting when there's a 45-minute Q&A portion, resulting in a much higher likelihood of getting your question addressed there. All right, so that covers off all of the housekeeping details. And for anyone that has attended any of these live webinars, for that matter, might be familiar with how Rob always quotes the song Remains the Same by Led Zeppelin. And if you just have good music taste, you'll know that phrase that reference as well. But and meaning rates backed off today and the market moved higher. It's all about the rates now. See where things go with that. And at this moment in time, that's all I have to say. So I'll introduce the man of the hour, Mr. Rob Roy.
Thanks, Zach. Certainly love to hear someone of your age quoting Led Zeppelin. So you've been paying attention, and you are right. Here you can see that still in the mountains. This is not the time of the year you leave the mountains. This is the time of year you come to the mountains with the leaves changing and everything. It's absolutely gorgeous. And also getting a better setup. Happy to report I have high-speed hardwired internet now. So hopefully there's no issues internet wise moving forward. Yeah, the song remains the same. You're correct, Zach. It's about rates in the market right now. If we take a look at the chart of the S&P, you can see that we moved to the upside. Now, we did move up yesterday as well, and the bond market wasn't open yesterday. The bond market was closed for Columbus Day, but the equities markets were open and kind of didn't know what direction we were going to go today. With all the news over the weekend, I'm sure everybody is very familiar with what's going on over in Israel with the surprise attack from Hamas. They're calling it, we always talk about this, how the media gets their buzzwords, their clip lines, and it's Israel's 911 is what they're calling that surprise attack. Israel is one of the friends of the U.S. We will likely help them if needed. So there's still that uncertainty of what happens from there. Obviously hasn't affected the markets too much. The futures were down Sunday night. The Dow futures were down 200 points when they first opened, which isn't that much considering the news. And then it moved to being only down 100 points when the market opened. And then, as you can see, that we did bounce back to the upside. So looking at the chart right now, for at least now, we have held that 420 level. We talked about that for a long time and told you we had that put butterfly on. That I had 420 as a mid strike, probably took it off a little bit too soon because it hit it absolutely dead on. But you can't complain about good profits. Take them when you can get them. But nice bounce off of this 420 level. So the questions now are, what do we do with this 50-day moving average, which is what we touched on the high? And you can see we backed off into the close after touching the 50-day moving average. Really hard to believe that we can go this far and not come fill this gap. So that gap on the 20th had a low of 438 and the high today was 437. So I know it's only a point on the SPY, but usually the gaps get completely filled. Perhaps that's as far as we go we're actually a tiny bit overbought right now, which is kind of interesting to think about, considering where we just were a week ago on the way down. And then with the news over the weekend, we do have a lot of resistance at 440, which was support for a while. You can see it was resistance back in June and July, tested as support in August, broke through it here in September. Haven't tested that yet. So perhaps we come up, fill this gap, and test that 440 level, and then we'll see what happens, or maybe we don't. The market's going to do what the market's going to do, but that seems feasible, I think, at this point in time. So moving to the bond market, looking at TNX, now you can see this little bitty dot there, and that's because, as I said, bond market was closed yesterday, and then there's that back off in rates that Zach talked about in the beginning. So we get a little bit of a reprieve on this pretty vertical move in rates. The negative is that it relabeled to a wave 3. So we probably have higher rates to go at some point down the road, but we had gotten a little ahead of ourselves. And we did break the 10-day moving average on the move down today. So we're kind of in no man's land. You can see that bar is just kind of hanging there right underneath the 10-day moving average. So it's going to be the same story. What happens with rates, at least right now, they are intertwined with the equities market. You get these correlations and they last as long as they last. Sometimes they last a while, sometimes not so long. But when you get these kind of correlations, and there's already normally a correlation between the bond market and the equities market. We've talked about that numerous times. To be a good equities trader, you have to have at least a working knowledge of the bond market. You don't have to be a bond expert, but certainly helpful. But their rates are really intertwined with what's going on in the equities market right now. So how long this bounce in the market lasts is going to depend greatly on what happens with rates. Do we continue to back off a bit? Could we come all the way back down to 4.3 here on the 10-year and get down to where we had that gap in September? Or is this just a momentary correction from a near vertical move where we relabeled from a wave 5 to a 3? And we see that 5 sitting there forecast as late as February of next year at 5.3 on the 10-year. I don't think we will be having a continued rally in the equities markets if we have a 10-year up at 5.3%. For now, we did have a break in the selling for the start of this week in the equities market. Taking a look at the dollar, you can see it gave us a little bit of a break as well. So you get a break in the interest rates, you get a break in the dollar, the two things that were just like a double whammy for equities, pushing things lower. So we come down, we find support at 420 on the SPY. The dollar backs off, rates back off. Clearly, that's a sign for the equities markets to go higher. And again, we'll just have to wait and see how long that lasts, because as you can see here, this is new recently. For a while, we had no 5-wave pattern in the dollar, and we have a wave 3 in the dollar as well. So if the dollar does continue higher and rates turn and head back higher, we're going to turn and head back lower in the equities market. Might be a good time to consider putting a little downside protection on, taking advantage of this bounce. I think if these two wave 3s hold true, we take a look at the VIX. And you can see that we have backed off here. We got all the way up to 20. Now that 17 to 18 level had been resistance for quite some time. Every time we came down to 13, we bounced up. We'd hit that level around 18, and then we would bounce down. Well, this time we broke above it, and now we're back in that area there around 17 or 18. So could this act as support on the VIX, and the VIX turns back to the upside, or are we just going to break back down and head lower? So as you can see, what happened the past couple of days to start the week has made an awful lot of sense in the markets. But where we go from here is a little cloudier, not quite as clear. One thing that is interesting is that Bitcoin has not participated in the rally to start the week, just going dead sideways here. staying right around that 27,000 level, just a little above 27,000. We have a little bit of a triangle here. It's not a huge one, but it's kind of a triangle nonetheless, with a bit of lower highs and higher lows there, which means that we're likely going to see some sort of a breakout move here. Not a huge one, but some sort of a breakout move here on Bitcoin in the not too distant future. And talking about breakouts, gives me an opportunity. We have a special guest with us tonight, Mr. Jeff Beamer, who is a former hedge fund manager, and I'm happy to report is now one of our traders at EWOTrader.com. We're super happy to have him there. He's been with us for a little while, and going to introduce him. He's got some interesting things to tell you about tonight. So I hope everybody joins me in welcoming Jeff to our TradeFinder broadcast tonight. You there, Jeff?
I am. Hey, Rob. Hey, Zach.
Good to see you.
Special occasion tonight. Good to see you, Jeff.
Glad to be here. Exciting time right now, actually, to be here. So
yeah, a little exciting over the weekend, wasn't it? And, kind of like, whoa. I'm kind of surprised. It's weird because I had this conversation with so many people that war is, historically kind of been a good thing for the markets, good for business, etc. You always hate to see that kind of thing going on because of the loss of life, etc. And we certainly feel for the people over in that area. But I was surprised that the markets didn't react more to it, at least at the open yesterday. But here we are. And so I know you're got some interesting things to talk about with breakouts. So certainly we could see one from here in the market in general, as well as Bitcoin.
well, it's there's a lot coming in. Really, the markets, as you know, that reacted were oil and interest rates. Interest rates kind of coming down a little bit, and then oil, or really the energy space, jumping. And speaking of jumping, we're headed into earnings season, and this is a great opportunity for me to kind of get in front of it and introduce a strategy that probably every option trader is familiar with. Not a lot of people are successful with, but we've perfected a methodology that has really, really shown how to trade this strategy. So what I'd like to do is to share my screen and go over just a few minutes of material and talking about an event that we have coming up tomorrow night. We're going to do a special presentation really about this earnings season and a strategy or strategies to trade around earnings season. And I'd like to bring that to you this evening. So let me just grab the screen here real quick. And I am going to, I just got a couple slides I want to show you. Zach, can you see, Rob, can you see my screen? Are we on?
Yeah.
I see Rob's screen still at the moment.
Okay, 1 second. And let's try that one.
We're live.
There we go.
All right. Amateur hour. All right. So let's talk about earnings season, and specifically stocks that react a certain way around earnings season. Now, I'm just going to go ahead and tell you the strategy that we're going to talk about is straddles and strangles. Okay. Now, again, when you are a new option trader, this is one of the first strategies that you learn about. Essentially buying a call, buying a put. The market could move either way, and you're making money. But how many of you have found that, well, there's a little bit more to it than just buying a call and buying a put? In fact, a lot of option traders have lost money doing this strategy over the years, but we know the nuances and some of the strategies behind the strategy that make it a powerful strategy to trade as we go into earnings. So a powerful strategy to trade on stocks as we go into the earnings season. Now, as you know, we want that stock to break out hard, up or down, to make this strategy effective. And one of the things that people do is they kind of pick the wrong stocks, quite frankly. All right. Well, with our little opportunity here, this week, believe it or not, the week of October 9th is kind of the lull behind the storm. Okay. Before the storm, there's only 100 companies approximately that are going to have earnings this week. Okay. There's some big names, but only 100. And then next week we grow to 355, and the following week over 1,000. The week of Halloween, we have 1,500. And then we just really, I mean, there's over 5,000 companies that are declaring earnings over the next 5 to 7 weeks. The opportunity that exists here is just absolutely tremendous. Now, we began to trade with a select group of traders earlier this year. Our strategy and the way that we trade straddles and strangles around these earnings events. And well, quite frankly, the returns have been outstanding. In fact, we have taken a fresh, brand new account and doubled it in 6 months. Okay. Now, let me just show you some of the power behind trading this strategy correctly around these certain events. All right. So I'm going to get more into this tomorrow night during our live event, but let me just show you some examples. This trade was given out last earnings cycle on July 17th is when this trade was given out. And just a few days later, this stock, which is Western Alliance Bancorp, declared earnings. We placed a straddle. So if you look on your screen here, you'll see a July 21st expiration 40 strike call and a July 21st 40 strike put. We have both options, the call and the put at the 40 strike. All right. Earnings came through. And if you look down here on this risk graph, and I'll expand it here for you a little bit, you can see on the earnings event the next day, this stock popped up over 8%. Okay. Finally settled back just a little bit, but was up 8%. And this trade generated off of a $666 debit. Well, actually, it was $333. We just happened to do 2 of these. Okay. We generated a 95% return in just a couple of days. Okay. Now, let me give you, I just have a few examples for you here. All right. Also on the same day, July 17th, was Carvana. CVNA is the symbol here. We entered this trade on the 17th, and literally a couple of days later, you can see here in the chart what happened. We entered the trade during this consolidation. Actually, Rob was showing you something very similar on the chart right before I jumped on about that consolidation area. The difference between that and this was we had a catalyst for an event. The stock gaps up over 40%, and this trade generated a return of 311% in just a couple of days. Okay, just a couple of days. That is, in fact, 2 days to be exact. In 2 days, a 311% return. Okay, now, not all trades are winners, as you can expect. Every now and then, things go wrong. So let me show you what happens when things go wrong. Okay, Rivian, as an example, we did a straddle on Rivian back on August 7th. We did the 24 straddle, 24 strike straddle. Okay, the stock had earnings. There was some volatility, but because of pricing and theta decay and implied volatility and the things that I will be teaching you to watch out for, okay, this went against us and the stock lost, the trade lost 30%, well, 33% on our max risk, okay? So the trade went wrong. We didn't lose 100%. We didn't lose half. We lost about 33%. We lost about a third of the maximum risk we put in the trade, which was $384 per spread. Okay, so we did 2 of them. That was $768. We lost $254. That occurred on that last earnings event for Rivian. But wait, just a couple of days later, in fact, let's see here, on the same day, oh, how about that? We issued a trade on a company called Upstart Holdings, UPST. This was the $54 strangle on August 7th. The debit there was $1,400, so a little pricey. Okay, you can see what happened, a 57% return on risk in just a couple of days. The stock had earnings, dropped again, and that's when we exited this trade. The announcement came out, but the phone call, the earnings call, didn't happen until the market closed. We stayed in the trade waiting for that earnings call. It happened after the market closed, and the next day, on what day is that? August 9th, this stock gapped down hard, and we got out on the 10th for a 57% return in just 4 days. Okay? Now, this is the exciting type of stuff that we're going to go over tomorrow night. This is what allowed our portfolio to essentially double. And you can see here, again, this is a different version of the graph I just showed you. Average trade return on investment is 74%, okay? Average winning trades were at 76%. Actually, that's gone up because we've had a couple of winners this month. So that number will be going up. But the average yearly, or the cumulative. Oh my God, a tongue twister. Should have started drinking. Has doubled. We've doubled since March. And with everything going on right now, you can expect another energized earnings season with over 5,000 companies poised with earnings over the next 6 weeks. So what we're going to do is we have a live presentation tomorrow night. And if Zach, you wouldn't mind dropping that link for registration in there. It's a free event. We're going to talk about straddles and strangles, and we're going to talk about how to trade them. Really getting you guys into a position to take this well-known strategy and start profiting with it right away. In fact, because this session is called TradeFinder, Rob, what do you think if I actually give them a trade?
I think that'd be awesome.
I mean, on a stock that's about to declare earnings. All right. So what I have for you is a straddle on Blackstone Group. Now, if you're not familiar with Blackstone Group, well, they're not hard to track down. Blackstone, they've been around for a while. All right. Now, this is a straddle using the 105 strikes. Okay, 105 call and the 105 put. The debit at the close of business today was $562 for that trade. Okay, so $5.62 in options language. All right, now we have earnings coming out next week. Okay, so we're doing this a little bit ahead of time to get you in position. All right, and then what I'd like to do, Rob, is next week come back and we can review this real quick as well as talk about some of the other things that are going on with earnings. What do you think about that?
I think that'd be great. Yeah. Good.
All right.
Follow along. Yeah, no, it's awesome.
So here we have earnings in 9 days. We're setting up the straddle now. Notice a little bit of consolidation going on in the stock. Okay. So there's a possibility that we get out before earnings, or we might wait until after earnings. That is why I want to come back next week, because we're going to make that decision as we head into the earnings event. So Rob, I hope everybody gets excited about this, as excited as I am, because I cannot wait for next week, really, when we start to get cranked up with these earnings announcements and see how stocks behave around those events. So
the timing couldn't be better, and I hope we've got a lot of great viewers that join us week in and week out, and this is an awesome opportunity. So if everybody signs up to watch your presentation tomorrow night, just to add a couple comments in there. I've always talked about how when I went to college, in the business courses that I took, they taught one option strategy, and it was straddles. And people will take straddles, and over the years, I'm sure you've heard it as well, people have always tried to put a straddle on right in front of earnings, trying to catch a move. But the key is, if you don't get an explosive move, then you suffer that IV. It's a little bit of a loss, as you showed on the one, but you're only going to be in these trades for a few days, so the losses are minimal. But you've devised a system that finds these explosive breakouts, and that's how you can generate these amazing returns. And doubling a portfolio in 6 months is phenomenal. As a hedge fund manager yourself, I'm sure those are the kind of returns that people dream of. So hopefully everybody tunes in, because that's the key. The key is the system that you found. You've created to find these explosive breakout moves, and that's what separates this system from just anyone trying to put a straddle on a stock into earnings and not having success. So I appreciate you being on, and look forward to having you next week, and look forward to watching your presentation tomorrow. Zach's put the link in there, so everybody sign up. And
we'll hope to see everybody tomorrow night. Rob, thanks for the time tonight. I appreciate it. You guys have this trade on Blackstone Group, and as I mentioned, I'll be back next week. We'll follow up with it, make a decision on what to do with it, whether we're going to take it off or keep it on through their earnings event. But once again, thanks a lot. Hope to see you tomorrow night.
All right.
I know I'm looking forward to it. So I was going to say, we had a question come through YouTube if this was going to be available on YouTube, and it's not. It'll be strictly on Zoom. So I will send that link through again. Don't want to miss out. I know I'm excited, and looking forward to it, Jeff. Thanks for coming on tonight.
Very good. All right.
Awesome stuff. Yeah. Can't wait for the presentation.
Thanks, guys.
So, thanks, Jeff. Appreciate it. I'm going to grab the screen back here, and hope everybody has found that link and signed up. As we mentioned, the difference there is the fact that he's found the method of finding the explosive breakouts on earnings. It's just a phenomenal system. All right, so let's do a quick look at some of the rest of the markets. As you can imagine, they're all going to be pretty much the same as what we saw. We'd had a number of different patterns form in the markets, but they kind of all came together at support areas. You can see right there on the DIA, they bounced off 330, just like the SPY, it bounced off 420. So we have these markets bouncing off these support levels. We talked about all these zigzag patterns that were coming to fruition here, and then the bounces off of support, and then taking a look at the Qs, which everybody always wants to look at. The Qs, same type of thing here. 360 was the area of support resistance that we found there, and then bouncing back to the upside. So we just have to wait and see. As we've talked about from the very beginning, it's going to all depend on rates, on how long this bounce can last, how long we're going to get a break in the rates. I think the rates are a little more important than the dollar, but just having the rates and the dollar going up in that wave 3 was too much for the markets, but a little bit of a reprieve. Now, one thing on the Qs is you can see we are above all the major moving averages on the Qs, the 10, 30, and 50. We've broken above those, where, as we showed on the SPY chart, we had only hit the 50-day moving average on the high. So are the Qs trying to lead here? Obviously, with rates coming down, that's going to put the Qs back in front, because interest rates are the difficult thing to overcome for the tech stocks. And so we've had a little bit of a bounce, not astronomical yet, though. So there could be more to come out of some of the big tech names. And then the IWM, the small caps, a lot of people look at this for risk, and look where we held. I mean, if you've been watching us for any length of time, how long we've been talking about the trading range between 170 and 190 after we broke down from 190 to 210 over a year ago. And then 170, as you can see, was support. 190 was resistance. And then we had tried to break above it back in January and couldn't hold it. Tried to break above it again in July and August, couldn't hold it. And back down. I finally got my test of 180, because for a couple months there, the trading range had tightened between 170 and 180. So we had just blew right through that test of 180 all the way back to 170, back above the 10-day moving average on the IWM as well. So it's been a nice bounce. We still have to wait and see, as I mentioned, how long this could play out, how long this could last. But for now, so far, so good. Now let's see what some of the international markets are doing. We'll look at Australia real quick, bouncing back, and kind of got into an area where it was really getting dicey, breaking below that level there where the wave 3 was. It's an 82% extension, so that's a pretty good extension. You have to wonder, is that the end of it? It could be, but look, again, just like our SPY, all we've done is get back to the 50-day moving average. And it would be an interesting place for the EWA to find support. There is some history there going back to June and July of last year, right in this area, but then we broke below that in September and August. September, October of last year. So it would be an interesting spot to hold, but perhaps it does. But again, we got to get above the 50-day moving average, just like we have to on the SPY as well. So Canada, you can imagine that they probably bounced, not back to the 50-day moving average here yet, though. So kind of lagging a little bit on the EWC. Did hold support there at its level of 32. So yeah, as you know, we could look at this a number of different ways. Zach quoting my Led Zeppelin quote of "The song remains the same between rates and the markets," but on all these markets, all the charts are the same. They all bounce off support, and they got a break in rates in order to bounce. So we got both things going. We hit a support level. We got a little reprieve in rates, and the markets were able to bounce. Let's take a look at India, which has been a strong driver, still is, came back down to just 44, basically just tested its 50-day moving average, and then back above it. We'll see if it can mount another run and try to break above the high at 45. It tried it there in early September, but it was a gap up, following a gap up. It was just too overbought. It couldn't hold it. I don't like either one of those things. I don't like gap ups, and I don't like vertical moves. And that was a double whammy, and it's just too much. And so backed off a little bit, but holding a pretty good area of support right here at 44. So trying to hold in that area. Goes all the way back to when that was resistance last year, summer and fall of last year. Same exact levels. So, none of these charts are that difficult to read. They're all showing, real basics of support, resistance, and moves from there. And then last but not least, looking at Germany, you can see that we had moved down, still in a wave 3 to the downside. Got a little bit of a bounce there, but not that significant. The key was, this is one of the markets that didn't hold their support level there at 27. It broke below it, and where it found support here was just, I think, bouncing with the rest of the global markets. But this area wasn't really that big of an area of support resistance. So getting below 27 was a bit surprising. I kind of would have thought that we might come down a little bit lower, and we still might, again, depending on whether or not rates and dollar resume their upward march or continue to give us a little bit of a breather. So I think that's, we're going back to when the German market for a long time was the weakest of all the international markets that we looked at. And then they had this really nice run where they were one of the best. They were right up there with India with the lows of September last year, and had that great run into March, April of this year, and then kind of went sideways. Now it seemed to be giving a lot of that back. So can we hold this level? Not anywhere near the 50-day moving average. We'd have to get back up to 27, which may happen because that was the support level. So we haven't tested that yet. So a little bit still remains to be seen there on the EWG to see whether that continues to bounce higher or not. So taking a look at some of our previous case studies, again, you got that one from Jeff for tonight. The ones that we've done here on TradeFinder, we looked at Camtech back on the 26th, 2 weeks ago, on this wave 3 pattern here. We were going sideways to see if we could mount some sort of a bounce. Obviously, we've had a bit of a rough time in the markets, but this trade is holding in there pretty well. You can see that we made it. If you go back and look at where the entry was, we were trading at $58, and we moved all the way up to a high of 65. That's a 7-point move. Remember, when we look at these, we look for a 10% move. So if you've been paying attention, and you know that we look for 10% moves out of these stocks, then you likely would have taken that off. And hopefully you did if you were following this one. Because in this market, to add a stock that moved 10% is pretty impressive. So we're going to close that one out and call that one another winner on these case study considerations. That same week, we looked at Qualcomm. So we had 2 of them. This was also on the 26th of September. And you can see held in there really well. Moved a little bit to the upside over the past couple of days, built a real nice base here around 110. So we'll see if we can mount a continued move to the upside. You can see we're sitting right here at the 50-day moving average, kind of like the S&P is. So we go back, we were at 109 when we entered that one. We're at 112 now. So $3 move, 3% move on a $100 stock, a little bit under that, but we'll see how it handles this 50-day moving average that it hit on the high of the day. That's going to be the key as to whether or not we can continue, but it certainly is attractive looking if we get a decent market with this base that it's built here around 110. Perhaps we can get a little bit of the old launch pad effect from people that have been around a while. We haven't seen too many of those lately, and we do have a little bit of a triangle here. So it does seem like something is about to happen here with Qualcomm. Maybe this one will move on earnings and show up on Jeff's radar screen. We'll have to wait and see how that plays out. You look at the ADX, which is one of the things I look at for consolidation, and we have had a low ADX throughout a good part of this consolidation in this triangle, getting all the way down to almost 13, which is a key level that I look for breakouts. Didn't quite make it down there, but it seems like something is going to happen with Qualcomm. So we'll stay with that. Normally get a little bit nervous with these triangles. As I've mentioned so many times, Elliott always talked about, regardless of what other patterns you're looking at, triangles trump everything. They can break either direction. Don't pick a direction on the triangles. So we'll give this a little bit of leeway here, see if we can break a bit higher, but we won't give it too much room. Should be a small gain in this one if you've been following along with it. Probably not much, but a little bit. So we'll see if we can mount some sort of a breakout there. And then last week we looked to the downside on open text, which I thought was pretty interesting from the sector that it was in. And we're looking for a continuation of that C wave in the zigzag. Hasn't happened. It's moved back to the upside. So this one's gone the other way. But it's testing that 61.8% extension. If it holds there, it's not unusual on the break of a fib level to test it before moving to the next one. So we're right at an area where if we break above this 61.8% level, then you would want to take that one off. Just take the small loss and move on. So that's going to be the key where it is now. Notice that it did touch that 61.8% level on the high and then backed off. So we'll see if it's just a test of that level. The fly in the ointment here is if it bounces above this level, is it only going to close this gap? That's the problem here. But I still feel like if it breaks above this 61.8% level, take it off. And if it just goes up and fills the gap and then rolls over again, we can always keep that on a watch list and look to re-enter on a move back down below the 61.8% level towards that 100% extension that we're looking for. So let's just give it a little bit of time and see if it's able to break back to the downside from here, or if it is determined to fill the gap, which it might. So as I said, let's not let it go that far. If it breaks above the 61.8% level there at call it 35.90 and closes there, take it off, let it fill the gap, and then we can always put it back on for a further breakdown move. So we'll just keep this one on close eye on it and on the watch list as well. So since we had a trade from Jeff, we'll let that be our case study for TradeFinder tonight. And with that, Zach, I'll go ahead and turn it over to you, and we'll do a little Q&A if we have any.
Yeah, that sounds great and right on time, even with the special presentation. So well done there. Let's go over to CCL out into Jan 24, please.
CCL, so good old Carnival Cruise Lines. You know, the cruise business. This is a little surprising to me, but it's probably on the back of what I hate, which are these vertical moves. You can see we started off okay coming out of these moves, and the cruise lines, the ships have just been absolutely jam-packed and selling way into the future. And people jumped on it and they caught this move higher here, but it was too vertical. And this is exactly why I don't like vertical moves, because what goes vertically up is going to come back down. Oftentimes it comes vertically down. This one didn't. It just kind of worked its way back down. But look where it is, right back exactly where it was when it started that vertical move. So it did retrace the entire vertical move. It just took a while, where a lot of times they come vertically back down. So the fact that we're sitting here at 13, real surprising to me. Let's see when the earnings report is on this. It's hard for me to imagine that this is not going to be, well, they already had earnings. So it didn't really affect the stock. So I'd have to go and look at, Jeff had talked about on that one trade how they had the conference call. The stock didn't really move on earnings, but it made us move on the conference call. And that could have been something here as well, because it was trying to. And then maybe they're seeing the bookings start to wane a bit. As you know, I'm in the camp that I do feel like it's likely we have a recession. It's not, not everybody agrees with that. You still hear the people talking about how strong the economy is and that we're going to have a soft landing or no landing, meaning no recession, et cetera. I still feel like there's going to be one. My disciplines, as you all know, you've heard me say this numerous times, will not allow me to just ignore what the bond market is telling us. And the bond market is screaming that we're going to have a recession. Maybe we do, maybe we don't. But my history, my experience has been, don't ignore the bond market. So perhaps stocks like this are looking towards people backing off. They had all the pent up demand to get back on cruise ships. We had the big, huge run, and then we've backed off. With all that said, if you wanted to take some sort of a shot at something and to see if perhaps you could catch a little bit of a bounce move, there is support right here at 13. There's resistance up here at 15. But you've got a little bit of a void here. You also have the 50-day moving average right there at 15. So perhaps we get some sort of a bounce here between 13 and 15. I don't know that we go much further than that if I'm right on the whole recession thing, but this has been a pretty significant move to the downside. Now, the key here, and the reason I say if you want to take a shot at something, this is what you kind of look for from a risk to reward standpoint. The reward, as we said, is a potential bounce up to 15, but the risk is we closed one day here below 13, no follow through. We got back to it today. If we break below that with follow through, you're out. So you're sitting right on support. So the risk is pretty small. And you could get a little bit of a gain on some sort of a bounce back to 15. So it's interesting from that standpoint, from a speculative standpoint, is what I would say there.
Very well. Thanks, Rob. All right. I noticed we did have a hand up, and as much as we'd love to hear your voice, we just don't have time for voice questions in this session. So please feel encouraged to ask that voice question on Thursday for our insiders meeting. Again, we have a 45-minute Q&A portion during that session, so much higher likelihood. We usually get through every question on those sessions. So please feel encouraged to ask that again on that day. Also, if you're enjoying this webinar so far, please don't forget to smash that like button for Rob. It goes a long way for us, and we greatly appreciate it. So we'll go on to this next question here from Julie. Hey, Rob, would like your thoughts on an upside buy on AEO. The weekly chart looks like there's some good consolidation on the moving averages, and the MACD and DMI look promising as well, bearing any geopolitical or government impact.
Isn't this one interesting? American Eagle Outfitters, a blast from the past. Some of these, once stalwart retail companies that were left for dead. This one and a few of the others, everybody knows what I'm talking about, that were in every single mall that you would go into, and they just did nothing for so long, just worked their way down here and just kind of sat around. Have all of a sudden caught a bid here over the last several months. So good on you for catching this one. And clearly you can see this. Now, the interesting thing here is, do you start the zigzag pattern from down here? And I don't think you do that, because we had a lot of consolidation here. So to me, the impulse move started right there. And so that's where I start the zigzag pattern. And we come down 56%. Corrective move. Now the 61.8% extension is going to give it some resistance, and it's also right at those highs from the beginning of September. So the problem with this one is the fact that we're right at an area of resistance, both from a fib level and a previous high. If it can get above that, I think you've got a free run here all the way to that 100% extension. So if we look at the DMI, you can see that we do have this positive directional indicator. Here's one of those kisses that I talk about, where the two directional indicators look like they were about to cross, but they just come together, kiss, and then spread back apart in the same way. So the positive directional indicator was above it. They came down, they touched, kissed. And so we still have buyers in control. The ADX hasn't really, it's not given a whole lot of love to this move right here. And then you take a look at that C wave extension, and we have a zigzag within that. So I'm going to take that one off. So just remember those levels because it's easy. The 61.8 is right there. And then you look and you can see that there's a zigzag within the C wave, which means that's a complex C wave. And that 100% extension there gets you to 18 and not too far away from where the 61.8% is on the big one. So you've got a couple different patterns telling you that we may move higher. I wish that ADX was a little more supportive on this bounce that we've had from September. But these are the stocks, these old retailers that were all the rage so many years ago have certainly caught a bid. So it would be interesting to see how it handles this. And as I say, usually I give two sides. If you're aggressive, you might enter now. If you're conservative, you might want to wait and see something happen. So if you're aggressive minded and understand that we're probably going to hit some resistance here at 17.5, even if we move higher from here, from both that 61.8% extension and that high from the beginning of September. But you've got a couple really good patterns showing you that there's a likelihood we break that. Now, if you're more conservative, let it break it first, because you've still got plenty of room for an upside trade up to 19 or above where that 100% extension was. So aggressive, you can take a shot now, again, understanding that you might bounce down a little bit from the 17.5 if you're aggressive. If you're conservative, let it break 17.5 and then jump in for the ride up to the 100% extension. But yeah, thanks for asking about that one. Give me a chance to talk about that, because it's just been mind-boggling. These companies were all the rage and nobody talked about them for so long, and they're back.
Yep, they definitely are on their way back. And some great analysis there, Rob, and great question from Julie. Let's go over to XBI.
Yeah, that's going to be an interesting to look at, the old biotechs. Just been, really difficult lately. And there was a time, when I talked about correlations, correlations exist until they don't, as I said at the beginning of the presentation. And right now we know rates in the markets are moving inversely. And there was a time when if the market were to weaken, money would move to biotechs. Now they're viewed as, and I think it's just, there's been so many of these companies and they come out with all these high expectations, and then they have, bad trials and drugs that don't work and all this kind of stuff happens. And then you see all kinds of bad news come out and losing trades. But when you take a look at this, it just as nice of a zigzag pattern as you would ever expect to see. This is, if you want to learn about zigzags, just keep looking at this chart, because this is exactly how they work. So we had an impulse move. We went right back up to the 61.8% level. You're supposed to go to 100%. We did. And then when you get to 100%, there's always a chance you could have an extended C wave, but that 100% is the initial target price. That's what it's supposed to do. It did it. And when you go to the extended level, oftentimes you will bounce up. You've heard me say all this stuff so many times. This is a perfect example of it. You bounce up, you test the previous fib level, and then you break down and go down to the extended level. And that's exactly what the XBI did. Now, are we going to go to a 261.8% extension? It happens, but not very often. That's pretty rare. And that's why I don't have it on my screen. I don't show the 261.8% level, just because the number of times that occurs is so minimal, it's not even worth really talking about. So here we go again. I think from an aggressive standpoint, you could take a shot, because we're right here at this level, and say, I think that, that's about it on the downward move on the XBI, and we could move higher from here. So bouncing off this 161.8% level, you're not going to really hit any resistance till we get back to the 100% level. So it should be a pretty clear run up to 76. And again, from a risk standpoint, if you break below the 161.8% level with follow through, because we did it once, no follow through day, all the rules we talk about over and over again. So whoever asked this, thank you for asking about this one. If it breaks 161.8, you're out. So you have a small amount of risk and you have a nice amount of gain if we can bounce off of this level. And that 161.8% level is going to be a very strong level of support. It could break it, but as I've said, historically, it doesn't do that very often. So from, again, a speculative standpoint, I like this one. So, but gosh, you gave me a golden child here for the reason I like zigzags so much, because that's what happened. They worked so well.
That's another great chart, and that was from JN on YouTube to give credit. We got just turned from 9:57. I was going to say 3 minutes. You got time for 3 symbols, but you still got time for 3 symbols.
Let's do three more. Yeah, let's.
All right, so let's go with the first one being CRM.
Good old Salesforce.
And Will.
Yeah. Leaving the earnings on there. We're kind of in between earnings reports there, so I'll take that off. And Will, Will, I don't know if you ask about Salesforce lately here, but it's the support is still 200. That's the key. It is a pretty good level of support. It was resistance back spring of this year, and then bounced up, had a little bit of a triangle breakout here. Right there, you can see there was the breakout. That's why we look at those on triangles. You can see this move here. So there was that breakout move, and then we zigzagged our way down, and we're sitting on this support level. So I think that, again, if you wanted to take a bit of a speculative shot, 200 is such a key level. The interesting thing is that even if it were to break below 200, which it held there in August, you've got another layer right there at 190. And I think the last time we looked at this, I talked about it. Now, if it doesn't hold 190, so you would have to decide whether or not you had the stomach to handle a move from 200 to 190. But that could hold. So it could give a bit of a head fake, come down to 190, hold there and bounce, but a break below 190, and it's really, really ugly from there. Almost a Katie bar the doors act, but
I was ready.
Yeah, because we have support at 130, and we've got a gap that hasn't been filled there at 170. So a break below 190, would be a fantastic short. And maybe that's the way you're looking. Well, I'm not sure, but if we can hold 200 here, we got a chance maybe if we continue this reprieve on rates and et cetera, to see some sort of a bounce higher move, at least back up to these highs in the 225 area. I just keep an eye on the 200 level. So next symbol.
All right, excuse me. Second to last symbol is going to be Qualcomm. We looked at this one a few sessions ago for risky seeds.
Yeah, well, we looked at it earlier tonight too, because it was one of our case studies that we gave out last week.
That's my fault. I got that one mixed up. Let's get FANG, actually, FANG.
Okay. They can go look at the recording to see Qualcomm. I think we hang in there and see what happens. You gotta laugh sometimes at these boards that come up with their symbols. So it's Diamondback. You think of Diamondback rattlesnakes, and FANG is a symbol. Which is not, what FANG became before Facebook, et cetera. But anyway, when we look at that, it cracks me up every time we see this. I hate this gap. Of course, anything energy got a little bit of a bid, as we talked about with oil moving up when Jeff first came on. You go over, and neither Israel or Palestine are big oil producers, but they're in an area where it could disrupt the transportation. of oil, which could cause some issues with supply. So that's where the gap up came from. And I always get nervous with those, especially when you gap up and you're right at resistance. So Doji today, and we'll see if it continues to stay in this area of resistance. But if it can break above it, I think that we have something. Now, I know a lot of these energy companies' earnings report isn't popping up on this one, but I know a lot of them towards the end of October reporting earnings. That could be a catalyst to break it above 155. And even though I'm always talking about, conservative versus aggressive, I think you got to let that one break above this resistance area here. Let it get to 160. If it does, then it could be off and running. And keep an eye out for when the earnings report is. It's hard to imagine some of these energy companies aren't going to have amazing earnings reports with where the price of oil has been over this past quarter. It feels like they're all going to be pretty darn good. Keep an eye on that doji from today, but you got to let that one break up to 160, I think, to go long there. And it may want to come back and fill that gap first too. So last one, Zach.
All right, well, I lied. I missed Risky Seeds question, and that was when I got mixed up with Qualcomm. So 2 symbols, and I promise this will be the last 2. It's EXAS for Risky Seeds.
Okay. Exact Sciences, and it's in a huge area of support. Earnings report on the horizon there, and you can see just this massive sideways move that it had at the beginning of the year. Took off, had a nice run, gave it all back, and it's now like no harm, no foul. Let's start over again. Didn't do so well on the last earnings report. That's what initiated this move down. So beware of that earnings report on the horizon there. If you wanted to be super aggressive and take a shot moving into earnings, because it's coming off such a strong level of support. That level right there at 60 is so strong. And there's stair steps down. Even if it breaks that, the only real negative is this gap that hasn't been filled yet. But so, beware of the earnings. It looks like they're on November 1st and had a gap up today with the market, which you wouldn't have gapped up because that could get filled in the next day or two. But yeah, this one would be super speculative, I think. And if it breaks below 60, then we're probably coming to fill this gap and you'd see 50. So that would be your exit there. But the fact that it's in an area that was support for so long and it was able to bounce off of it before, perhaps it can do it again. But yeah, keep that earnings report in the back of your mind.
Awesome.
All right, now the last one.
All right, just 5 more symbols for you. I'm just kidding. So just real quickly, I just want to remind everyone that we do have that special presentation going on tomorrow night for Jeff. I'll drop that link in the chat again. Please feel encouraged to register that. It's completely free of cost, and it's going to be very informative. If you're interested at all about what Jeff was presenting on a bit earlier, he will be elaborating in much further detail tomorrow evening. Also, please don't forget to hit that like button. And lastly, the last question for the evening is from Beth, who is a first-time subscriber or watcher, rather, from Zoom, and says, "Hi, Rob. My first time watching live. Would you take a look at SGML, please? Thanks."
Well, thanks for joining us live and looking at a
SGM as in Maverick.
SGM. Slightly different. Well, we're still in that space though. We're going from gold to lithium. But lithium was on fire, as you can see at the beginning of the year. And we all know why that is, because we need them for those EVs, right? So we had a big run for coming out of last summer, consolidated for a bit, took off once again, and then came back down, which is a little bit interesting, kind of head scratching as to why that would occur. Doesn't seem like EV products are going to be going away anytime soon, and this is going to be something that's certainly needed. So we had this zigzag pattern to the downside here. Let's see if we hit our target price yet. We have, so we went to the 100%. Looks like it wants to bounce, and so there's going to be a little resistance here at this 61.8% level. I like this one, especially if you have maybe perhaps a little bit of a longer term time horizon here, because like I said, I just don't think that demand is going to be going down, and it's just take advantage of this move to the downside here and see what happens. So I think you might have to have a little bit of patience with it in case we go a little bit lower first. But I think at least a short-term bounce here is warranted. It might bump its head a little at 30, and that's where the 10-day moving average is. We've got this doji here, so keep an eye on that in tomorrow's trade, see how that plays out. But it seems like you could get a bounce up to somewhere around this 35 area. So yeah, this one is, I think this is more of a position type trade than something on the short term. If you got a long-term horizon, time horizon, I think you're getting a pretty discounted price here. See how that plays out. I like to keep an eye on that one. So thanks for viewing. Beth, thanks for asking the question. And for everyone, as always, appreciate your time. Time's the most valuable asset we all have. And we very much appreciate when you spend some of your valuable time with us. Hopefully, as always, you found tonight informative. And yeah, take a look at Jeff's session tomorrow night on those explosive earnings breakouts. Couldn't be a better time for it with earnings season coming up. Thanks, everybody. Have a great rest of your week. And yeah, we'll have to keep an eye on what's happening with the conflict, as well as the two flies in the ointment there, interest rates and the dollar.